Behind every scam, behind every breach, behind every digital crime, lies a hidden network waiting to be exposed. Welcome to Dark Tech Files.
In 2001, billions of rupees belonging to Indian banks and public institutions evaporated. At the center was one man who orchestrated the movement of this capital, while financial institutions followed his lead. Ketan Parekh came from a family of established stockbrokers. He maintained an extremely low profile, quietly navigating the market even as the 1992 Harshad Mehta scandal dismantled the reputations of those around him. The turning point came in 1998. Following India's nuclear tests, foreign institutional investors rapidly exited the market. The sudden withdrawal of their capital triggered a major crash. This crash demonstrated that institutional capital dictated the market's movement, overshadowing the influence of individual retail traders. Parekh began building a network that connected both sides of the trade. He secured discounted shares from the promoters of small companies, while simultaneously cultivating the financiers capable of providing large-scale funding. Dominating the market required the same institutional giants to buy the specific shares Parekh intended to sell. He selected 10 companies in the burgeoning IT, communications, and media sectors to serve as his primary vehicles. These became known as the K10 stocks. The growth of these stocks was vertical. HFCL rose from 40 rupees to 2,500, while Global Telesystems climbed from 80 to over 3,500. These prices created a sense of momentum that drew in massive institutional money. Entities like UTI and LIC invested heavily, fearing they would miss the returns of the tech boom. Parekh's public profile shifted alongside the market. By 2000, he was hosting an extravagant millennium party at the Taj Hotel, attended by the highest levels of Bollywood and corporate India. The Indian financial sector began to treat these penny stocks as high-value assets. The illusion of growth had become a self-fulfilling reality. This strategy relied on a specific mechanic: circular trading. Parekh used a network of brokers to pass the same sets of shares back and forth. By selling within this closed loop, they could generate enormous activity without the shares ever leaving their control. This manufactured volume appears on market dashboards as organic demand. It triggers the indicators used by institutional analysts, signaling that a stock is a high-liquidity buy. At its peak, the scale was absolute. On November 21, 2000, circular trades accounted for 99% of Adani Export shares on the Bombay Exchange. Companies participated by using their inflated share prices as collateral for bank loans. That borrowed capital was then funneled back into the market to support the stock prices further. Circular trading requires a constant influx of fresh cash to maintain rising prices. Without new capital to buy the shares at the next level, the loop collapses. Maintaining this daily volume required a massive, constant influx of fresh cash. Parekh secured this funding through deep-seated connections at Madhavpura Cooperative Bank and Global Trust Bank. He utilized pay orders. Parekh's firms deposited inflated K10 shares as collateral, and the banks issued pay orders, essentially guarantees of funds that the bank did not actually possess. These pay orders were converted into cash through a web of shell companies. This money was then used to buy more K10 stocks, driving the prices even higher. Parekh had found a way to use fraudulent bank credit to inflate the very shares he was using to secure the credit. The global dot-com burst in 2000 ended the expansion. As technology stocks crashed worldwide, the extreme valuations of the K10 stocks came under pressure. A group of rival traders, led by Radhakishan Damani and known as the Bear Cartel, identified the gap between the K10 prices and their actual value. They utilized short selling. The cartel borrowed K10 shares and sold them at their peak, betting they could buy them back much cheaper after the prices fell. As the short sellers drove prices down by 95%, Parekh's collateral was wiped out. Madhavpura Bank, having lent far beyond its means, defaulted on 130 crore rupees. Once the institutions lost confidence and stopped buying, the multi-billion rupee machine lacked the cash to sustain itself and disintegrated. Following the devastating market crash in 2001, the CBI arrested Ketan Parekh. The legal proceedings revealed deep political ties. A 2004 CID report alleged that bribery occurred between Parekh and bank directors to prevent the cancellation of his bail. Political interference hindered the fallout. The officer who documented these connections faced professional victimization and transfer shortly after filing his report. SEBI eventually issued a 14-year ban from trading. Despite the scale of the manipulation, Parekh avoided lengthy imprisonment, often having his sentences suspended by higher courts. The administrative penalties failed to neutralize the threat, leaving the door open for a return to the markets. In January 2025, investigators caught Parekh manipulating the market again, years after his original ban had expired. His new method was front-running. Using non-public information from an insider at Tiger Global, Parekh knew exactly which shares the massive firm was about to trade. His proxies would buy shares fractions of a second before Tiger Global's massive orders. When the firm's purchase inevitably pushed the price up, Parekh's group sold for an immediate profit. Manipulators adapt to the environment. Parekh simply transitioned from manual circular trades to exploiting the blind spots of the modern digital regulatory system. Every form of market manipulation relies on the same core principle: creating artificial demand to exploit the trust of institutional systems. The warning signs remain consistent. Inexplicable trading volumes and penny stocks surging without fundamental business changes are signals of a compromised market. While markets run on capital, trust is their most essential asset. When that trust is compromised, the cost is eventually paid by everyone. Ketan Parekh's trial remains a real-time warning for global investors about the inherent fragility of the financial ecosystem.
This investigation may be over, but the digital underworld never sleeps. New threats remain hidden, and we'll be here to uncover them. Subscribe to Dark Tech Files.